Ah, yes, coffee is for closers. Hmm. Well, the Dow's attempt, or I should say the overall stock market's attempt at a relief rally has kind of come and gone. We had a tough day Monday, Dow down over 1,000 points. Today's Wednesday, but yesterday we had a mild rebound. And what I said yesterday is that when stocks rebound a lot, and by the end of the day, they give back almost the entire rebound, it's typically not a good sign for follow through. And we saw that today. It followed through with the downside, and that's exactly what we expected, what we talked about. I've been saying that it's a little early uh, to jump into stocks wholeheartedly and say, let me just buy everything that was sold off because, right away, we're just going to go back to previous all time highs and everything, and we're going to look brilliant, make a lot of money. I think that's a little unrealistic. And I think investors are going to require a lot more patience than that, especially when I look at some of the large mega cap tech stocks, the big artificial intelligence enthusiasm beneficiaries. They've broken massive support levels. They've gone below stock prices that I think they've gone below certain prices I think will encourage more selling rather than buying. We'll get into that. We'll talk about two examples and others that tell us that being a long term investor doesn't necessarily bail you out. Time does not heal all wounds. And there are some stocks that were mega winners from the dot com era, the last time we saw tech stocks do what they're doing now, that have never ever recovered. And these are major, big company names that some people may actually still be holding on to. So let's roll a quick intro and we'll get into this. This is going to be a quick one. Please stick around while you're watching. Give us a like, thumbs up. It helps your other contacts in your LinkedIn or Facebook, what have you, helps them see it. If you're watching on YouTube, please give us a like and a subscribe. And of course, if you have any questions, especially if you're watching on LinkedIn or Facebook, ask in the comments. I would be absolutely delighted to address those and answer your questions. Here we go. All right, thank you so much for joining me. Let's just take a quick look at what happened in markets today. That's not what I wanted to hold. Here we go. Okay, pop myself. Oh, no, hold on. Here we go. You see that? Okay. So the Dow was up a couple hundred points earlier in the day. And then by the time we got into the late morning, early afternoon, those gains started to disappear. We talked about this that, let's just, market had a couple of big down days, couple of big down weeks, especially the NASDAQ. Let's just go out and buy everything on sale. And you see articles. You actually see articles on major media websites that say, with people saying now is a good time to buy. These stocks are on sale. You should own them. And they go down more. You know, uh, I was on TV yesterday. If you didn't know, hmm. A lot of you know because I told a lot of you, and I posted about it. But what I said is a couple of things. About the things that you should know about personal finance. That if you want to, buy or sell, do this based on your personal finance because if you're going to buy or sell a stock or an exchange traded fund, you don't know if it's at its peak or not, and you're not going to know until after the fact. So make your decisions based on your risk tolerance, or if a position or an ETF or a stock, what have you, is too big a portion of your account or too small a portion of your account. Consider rebalancing. These are the kinds of things long term monitoring and doing on a consistent basis are way more important than trying to land that Sunday punch where you're just going to sell everything now and at the bottom of the next stock market bear market you're just going to buy everything back and make a fortune, live happily ever after. Ain't happening to me, ain't happening to you. That's not what's going to work. But consistent strategy, even if it's not the best strategy, there is really no such thing as a best strategy, but a strategy that you can use consistently is what you should do. Now, let's just take a quick look here. So the Dow down to 34, NASDAQ, S&P down, gold down, 10-year yield catching up a little bit, getting closer to 4% again. A lot of people think that unless we're going into a true recession, 10-year yield probably should not be under 4%. There's a lot of bond issuance. The debt of the United States has gotten a lot bigger. So unless you see a true recession, I'm not really sure why the 10-year would be below 4%. So 4% is the line in the sand for the 10-year treasury. We go above 4%, it's probably a good omen for the economy. We go below 4%, it's probably a bad omen for the economy, at least on the short term. Let's take a look at the Russell 2000. Russell 2000 down 1.4%. So that was the best performing index. It's all you heard about in the month of July. And now it's giving it back in August. Not all of it. It's still up a lot, but, from the last month and a half. But not really seeing a follow through in terms of purchasing in there. And it went up because of possible interest rate cuts, so stimulate the economy. But if the economy is now going into recession, doesn't really matter how much you cut interest rates. It's going to hurt small cap stocks more than large cap stocks for at least for a while. All right. So wanted to point that out. Let's talk about the FANG ammo. Now they call them the Magnificent Seven. Okay. But NVIDIA, look at this. NVIDIA was up a little today. It's still down over $5 in the day, below $100 a share. If you recall, after the NVIDIA split, 10 for 1 split, it was 1,200. So splits at 120. So 120. It went to 140. And once it went down below 120, I said, they broke their pre-split level of 120, aka 1,200 pre-split. That's a bad omen. Tactically, the stock is broken, and now investors are more concerned about protecting profit than initiating new positions. And now that it went from 120 down to 98, below 100, 100 is a pretty significant level on a stock. It shouldn't make sense, but it's the way it is. 100 or above or below. But it broke 100. I think that just continues the negativity, and being down over 5% today, and yesterday an up day in the market recovery, NVIDIA was barely up. So the downtrend continues. Tesla broke below 200. Meta just cannot hold that $500 price level. Microsoft is not holding 400. Netflix is not part of the Mag 7, but I just leave it up here because it's a pretty big company. I just used to following it, but nothing tough to come up with a case either way. I'm just talking about price levels, not buy or sell recommendations. Okay, my compliance peeps out there, I love what you do, and I just want to make sure we understand each other in this, okay? So please allow me some grace here. By the way, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. Google not holding the 190, let alone the 160. Amazon couldn't hold 200. Now we're wondering if it's going to hold 160. Apple, we'll see. I think the $200 figure for Apple is an important one, but things are looking pretty tough. All right. So, this is why I can't tell you for sure if the selling from the last few weeks is over or not, but I am saying that these stocks are trading like it's not over. Infer from that what you will. They could easily turn around and go right back up tomorrow, given the right news, the right economic news. But you'd have to get a lot of really good things, or you'd have to get like really good manufacturing numbers, economic manufacturing stats or good employment stats, because we need good news has been bad news. Good news for the economy means the Fed holds rates higher, inflation stays high. Okay, so that would be bad for the market, because if inflation's high and the Fed's not cutting rates, stocks would go down. So it became bad news is good news. So bad economic news is good for the stock market, because it means the Fed will cut rates and inflation is going down and stocks go up. Well, now bad news is bad news, because if there's a true recession on the horizon, earnings could collapse. Now, we don't know. Okay. Now, we don't know for sure if a recession is coming or not. It's just that enough investors have pretty much topped out in terms of how much money they could get into the stock market. They've done it. That's why you could make the case that stocks became overvalued. So you're now going into some profit taking, profit protection. And not a whole lot of new money coming into the market. Plus, Warren Buffett sold, what, $100 billion or something of stock. He sold Apple. He sold Bank of America. So that's spooking some people because what does the Oracle of Omaha see what we don't? And it's another thing that's another thing that frightened investors a bit. So it's a lot easier to make the case for a down market now, I think, than an up market. I could make the case for both. Now let's talk about long term, all right? Because there is some silly, silly stuff going on. All right, I'm going to go back to the screen. Okay, here's a headline that just came out a little while ago, which I thought was not helpful. Mag 7, Magnificent Seven stocks. Mag 7 stocks are cheap and to buy after sell off, as long as no recession. Morgan Stanley says, as long as no recession. It's just not helpful. As long as no recession. I mean, no SH bleep IT Sherlock. Doesn't that go for like the whole stock market? Yeah, industrial stocks will be okay as long as there's no recession. Consumer discretionary stocks will be okay. I think they'll be fine as long as there's no recession. I mean, give me a break. Everything will be okay as long as there's no recession. I don't think that is helpful. And the other article that I'm looking at is this one. Jamie Dimon, who I'm a fan of, by the way, CEO and chairman of JP Morgan, biggest bank in the world. Jamie Dimon says he still sees a recession on the horizon. Now, he's been warning about a recession on the horizon for a very long time. And I just want to be clear about what I say. There's always a recession on the horizon because the economy is always in a cycle. We build up, we break down, then we build up higher, we break down, we build up, we break down. Cycles have not stopped. We will always have a recession, and we will always have what comes after recession, an economic recovery. And after an economic recovery, we hum along at an economic expansion until either we get an inventory overhang or consumers become tapped out or some other happening economic event, exogenous event, whatever it is, maybe a huge and lasting spike in the price of oil. Lots of things could throw the economy into a recession, but basically, economic expansions wear out, regardless of what the reason is. They wear out, and then we go into recession. That always happens. So to say that I see a recession sometime on the horizon doesn't really help us. Doesn't help you. Doesn't help me. You know what helps? Investing based on your time horizon. We always say time horizon because the biggest determinant of your risk tolerance is how long you have to invest. If you have a long time to invest, you don't need the money you're invested. That if you don't need the money that you're investing for a long time, you have a higher risk tolerance because you could live through the ups and downs of the stock market. And if your time horizon is short for when you need the money in your portfolio, well, then you don't have a lot of risk tolerance. You have a low risk tolerance because you're going to need that money soon. So you really can't take the chance of the stock market going down and not having enough cash to meet your upcoming financial obligations. So that's why we always like to say it could be a year, 2 or 3 years, depending on the person and the situation, that, when you have financial obligations in that time frame, that money probably shouldn't be invested in the stock market, which is volatile. It should be in cash equivalents. And that could be, checking, savings, T-bills, CDs, short-term things, cash equivalents. Okay. So this is common sense, but a lot of people don't follow that. But if you do, it helps you get through the ups and downs of the stock market. Now, I want to talk to you about long-term holding, because, NVIDIA has just been the biggest name, the hottest stock for a long time now. And people always ask me, should I buy it? What should I do? Not necessarily clients. I'm talking just friends, relatives. Should I buy NVIDIA? Should I not buy it? Oh, no, I don't care. I'm buying it for the long term. This artificial intelligence thing is going to be huge. And I share my thoughts, but I think by the time people say something like that to me, they've already made up their minds. They're going to buy it. And that's okay. That's what makes the market a market. Some people see something as good, some people don't, and we trade around that. So the question about Nvidia, I want to get off of whether if you should buy that or not. That is really for conversation that you and I could have one on one. So reach out to me if you want to talk about that. Hopefully, you'll want to talk about your overall investment picture and your financial needs, and we'll talk about planning, things like that. I'd much rather get into that than just real quick. Should I buy or sell Nvidia? Because my answer to that is always it depends on a whole bunch of things, which we need to talk about. But if you want to ask me that really quick and be off the phone really quick, I'm just going to say, I really can't tell you that. All right. It's not because I don't know. Well, I don't know. I know other things that help me make up my mind. But I could tell you this the market capitalization, the wealth, the value of all of the NVIDIA shares combined went to a little over $3 trillion. If you look at the value of what Google and Microsoft and Apple and Meta and so many others and other companies like Broadcom and other, artificial intelligence umbrella stocks, right? Stocks that fall under that AI umbrella, trillions of dollars of value have been created by enthusiastic investors bidding up the stocks. And granted, the market for AI, the value that we wring out of artificial intelligence in the global economy could be worth trillions of dollars. But if the value of the stocks, the way we invest, has already created trillions of dollars of valuation, doesn't that mean that we've already gotten the value out of artificial intelligence as far as investing goes? It's already done. It's, not that it's over, but it's already done. And we don't even know which companies are going to really be the biggest winners in artificial intelligence. So that can mean some of these stocks are overvalued. Some of them are going to continue on. We don't know exactly which ones yet because the real AI platform that we're all going to settle on, the right standards, the right chips, the right software, or I should say the most widely used ones, haven't really been discovered yet. Maybe it's NVIDIA as the chip company, the backbone of AI, of generative AI. It's early in the game. And so far, companies investing in AI are technology companies hoping to create something that'll be worthy enough to be purchased by regular companies like Target and Costco and GM and Chipotle and Starbucks and other companies that are just what we call the non-tech sector. We shall see if it's worth it. It could also be that it's like buying big shoes for a little kid. You buy bigger shoes than a child's actual shoe size because you want the shoes to last. And maybe your child is a size 4, but you buy them a size 6 because you want them to have those shoes for at least a little while because, kids, their feet grow so quickly. Same thing, I think, could be with artificial intelligence stocks. The market cap of these companies has grown ahead of the opportunity, at least for now. So now we have to wait. We have to wait and see the artificial intelligence business grow enough and grow into the shoes of how big the investments have become. Let's take a look at what happens when stocks get too big for the opportunity. Okay, so I'm going to show you 2 stocks. All right, the first one is going to be this one. Let's take a look at Intel. Intel is below $20 now. All right. And I could tell you that even during the Great Recession, which I can't believe was 12 years ago, more than 12 years, 14 years ago. Crazy how long ago that was, more than 14 years ago. Intel didn't even go down to $20 a share. And in its peak, I don't know if you can see that, but in March of 2000, Intel reached a peak of $70. That was a trading high. It closed at 66, but its all-time trading high was 70. And if you look at the chart here, Intel has never reached 70 again 24 years later. Could it reach it one day? I guess so. But if you were 60 years old and you own Intel, you'd be 84 if you're still alive to hold on to it. That's an awful long time to hold on to a stock to keep losing money. But hope springs eternal. And the other one I want to point out is Cisco. All right, let's see if we can make this a little bigger. Wait, hold on a sec. Cisco. Okay, here we go. Cisco, all right, reached an all-time peak in January of 2000. Remember, that's when the dot-com bubble peaked in 2000, just when the internet was becoming mainstream. And the internet became bigger than the internet became bigger than anyone ever thought it could. But the value of the stocks actually became bigger than the eventual opportunity of the internet, at least for a very long time. But 24 years later, stock peaked at 77. It's 45. And if you look at this yellow line, 24 years later, it's never reached its 2000 peak. So as big as the internet is today, as big as the revenue and earnings of these companies are today, Intel and Cisco, which is actually bigger than it was in 2000, the stocks got caught up in investor enthusiasm, and they've never even come close to where they used to be. So these are two examples of stocks that investors said, hey, I'm holding it for the long term. I'm not worried about it. That the long term didn't work. Now, I know I'm cherry picking, but you could have picked Sun Microsystems, EMC, AOL, Yahoo, JDS Uniphase, Quest Corporation, so many others that were beneficiaries of the dot-com era enthusiasm that you might not have even picked, for example, Microsoft or Apple. So you still could have been diversified with a number of big tech picks and still lose your shirt decades later with no chance, up until now at least, of recovery. And that's why individual stocks is hard. And that's why I say that I don't mind individual stocks. It's a big part of what I do for my clients. But as they go up, I do like to take profits in them as part of my strategy. And I whittle these companies down to a manageable size in someone's portfolio so that if they do become dead money or they collapse, it's not killing me and the entire portfolio. That's the point when I like to say, just because you're saying long term, that's no cure-all, it's no fail-safe for something going wrong. Have a great night. Thanks so much for watching. I'll be back tomorrow. If you have any questions, get back to me. Leave them in the comments. I will see those. I will reply to you. And again, thanks for sticking around. Bye.